Hello, welcome back. We're going to chat about Tencent Holdings, and this is a stock that is actually sold right now in the US. It's an OTC stock, but you can still buy it. And this is a company that has been following the Chinese trend, I guess. It has been going higher and then at some point start falling down. That's because of the recent issues between China and the US and some regulations. We talked about it extensively for Alibaba as well. And a lot of Chinese companies have actually suffered because of that. Now we're going to be examining Tencent regardless and see whether it's an interesting buy over here at $59. And we're going to do it by taking a look at the financials as we usually do, see how much money the company makes, and also prepare a discounted cash flow model at the very end of the video in order to discover what kind of price we're willing to pay for the company. But it's really important to examine all the other aspects of the company and understand what they are doing as well. Now, first things first, the outstanding shares of the company are sitting at 9.5 billion. That's a lot of shares. Now, people may think that shares matter, the amount of shares matter. It doesn't matter at all. What matters is the market cap, because you can affect that by just adjusting the market value, the market price. So it doesn't really matter at all. It's just interesting that they're having that many shares. And they're actually paying a dividend yield, which I checked earlier. And their payout ratio, you can actually see it here, it's very low. Let me find it in the dividends tab. It's actually very low. It's sitting at 7.5%, so they don't have any trouble paying it out from their income, really. So no issues there. And it's a nice thing to have a little bit of extra money. That's pretty considerable, actually. It's a good amount of dividend that they can actually sustain very easily. So that's very, very nice to see. And let's go back and examine the income statement of the company. You will see here that the year-over-year growth tends to be at around 20 to 25% for their total revenues, from 36.5 to 85 billion over here. So they are growing their revenues nicely. Same with their gross profit, also growing very nicely. And you will see that their operating income also increases from 11.3 to 20.3 billion. And at the very bottom, the bottom line, which is the most important thing, the net income from 11 billion, that used to be 2017, to now sitting at almost 30, 29.3. So the company has almost tripled its net income in 4 or 5 years' time. So that's awesome. The balance sheet. The balance sheet of the company it has two things that are very, very important. The total liabilities here, 98.6 billion, almost 100 billion, really, in total liabilities. That's a lot of liabilities, really. But it really matters how much money the company is making. But the total equity is sitting at 144 billion, so more equity than liabilities by about 1.5% X or so. So the cash flow statement, the company is making money from operations that also keeps increasing from 16.3 billion to 27, almost approaching 27 billion. So that's nice to see. And investing, which is something that I like to see, investing in markets and equities. Investing a lot here, as you can see. Companies are investing every year in the markets. That's good. Cash from financing. The cash from financing here is positive, and that happens just because the company is actually issuing a lot of debt here. Now, this can be okay, but in some situations it can be problematic. And I guess the company has its limits, but we will examine how much debt they have. And we already saw that the total liabilities were sitting at 100 billion, really. You will see here that they are repurchasing back common stock, which is good to see for investors. And also they are actually paying some dividends, which are sort of negligible based on what they are making, really, as you will see. We actually already saw it, it's about 7%. But the cash flow, the free cash flow, from 15.4 billion increasing to 22 billion, while in 2020 was actually a little bit better. So that's worthwhile to see it as well. Multiples of the company sitting at 7, 6, 6.7, 5.8. This is slightly more than I'd like to see. Probably actually almost double as much as I would like to see. Typically I like to see something like 3 here. But that's not the end all be all, of course. And profitability, the return on equity is 25%. That's pretty good and consistent actually. So that's nice. And by the way, return on equity is basically is a metric that actually shows you how efficient a company is with using their equity. So the stockholders, how much the stockholders are actually making year over year on their equity. And so a company that makes more on their equity knows how to invest. They're investing well. They're using their money in good ways. And so this kind of tells you, how well this money is used. And 25% is very good. So solvency. Yeah, the company has a 35% total debt to equity, which is about what I would expect on about average. It's not too overbloated. Yet in absolute values, the company has a lot of debt, but in terms of their equity, it's not that much. And the other thing that we want to examine here, of course, is the cash flow and see whether it makes sense to buy the company at its current price, which is $59, or we would want to wait a little bit. And so if we go back, you'll see that the company had 9.53 billion in shares, and we're going to be using the cash flow statement over here to populate it to the DCF model. These are the values that are populated over here that I have already pre-populated so that you don't have to wait. And so these are the last 5 years of historical data that we have for the company. And we're going to use a discount rate of, let's say, 12% is how much I want to be making a year from the company. This typically has to be more than 10% because you can just buy an S&P 500 ETF or a mutual fund, index fund, and you will actually be making about 10% a year. Free cash flow to use here is going to be based off of these values, and you will see that some years it was positive, some years it was negative. So I think I'm gonna go as conservative as I should potentially here as I can. Maybe I'm not even that conservative. So I'm just gonna use 10% here, which may actually not be that conservative for 10 years. Probably is not, but we're gonna use this for our estimates. And a perpetual growth rate of 1% I think is fair. And that's the amount of free cash flow growth in perpetuity after the 10 years. And also all these values are discounted for the present value. So that's very normal in discounted cash flow models. And the price, this gives us a price per share to pay that's about $38.48 here. And currently we're sitting at 59.10. So we need to see a pretty significant decline in order to buy based on these metrics over here. Now, if the company somehow grew 15%, now we're sitting at a value that is very, very close, but it's actually not there yet even. So it would have to be maybe like, what, 18%, 17 maybe. Yeah, closer to 16 to 17% of free cash flow growth a year in order to, to sustain this kind of price per share to pay for our model here. So hopefully that gives you a little bit of an idea on what is a good price to pay for the company right now. So if there is a steeper decline, I think I would consider it, but right now I think it's a little bit expensive for my liking. It's a great company, very, very good company here, but I'd like to get a cheaper discount, a better discount, if possible. And if that happens, maybe I could enter, and I would look to enter around here, really, this kind of base, if it's ever reached. I would really consider entering the company. Otherwise, I'm just waiting on it. So let me know if you're holding Tencent or if you're thinking about it. Tell me what your thoughts are, and I'd love to hear those. And if you did enjoy this video, take a look at this one that I made earlier. It actually discusses what happened with Tencent and Alibaba in terms of the US and them being nominated as notorious markets in the notorious markets list. So that's very, very interesting to watch. Thank you for watching this one, and if you did like it, please leave a like and subscribe. And you can also join our Discord channel. You can find a link in the description box below. I'll see you soon. Bye bye.